when you're growing up, you think about you were just talking about the things that you wanted, right?
Sure.
We think about the $100 sneakers that we want. We never think about being able to start an apparel company, right? We think about the $5 coffee that we want, but we don't think about owning the coffee shop, right? And it's these things that just as we grow up, or at least how I grew up, or how I think a lot of people grew up, we don't talk about money in that way.
Investors, welcome back to the channel for another go round of Masters of the Market. Now, if you are brand new here, my name is Ari Gutman. Of course, every single week on my channel, I am dishing out brand new dividend stock ideas and talking about the latest insights when it comes to economics. But I am fortunate enough today to have with me on the Masters of the Market show, Matt Darren, who has an incredible story from investing into higher growth stocks, into Bitcoin, and then finding his way into dividend investing. First and foremost, Matt, I want to say thank you to you for joining me on a Masters of the Market chat, welcome you to the channel, and immediately, as I always do, put you on the hot seat.
I'm ready. I just want to say, hey, I appreciate you having me, and I'm excited. Let's get to it.
Let's do it. Matt, that first question I have for you comes down to the total value of your portfolio.
Yeah. So the portfolio that I share on my channel and that I update or I talk about what I'm doing there is at about 225K. It's a mix between a bunch of different account types, and I kind of do that on purpose because it helps me to stay up to date on the different tax implications and contribution limits and all that, which I also talk about on my channel. So that's my kind of primary portfolio. I do have a couple other accounts, like obviously I'm married, so me and my wife have accounts, and she has her 401k. I don't necessarily share those, but they're basically all invested in the S&P 500 index, so they're not all that exotic. But for the portfolio that I have on my channel, it's about 225K.
225K in the portfolio that you're going to see on Matt's channel. Of course, I just want to mention this right here. The last video I caught from Matt was a dividend investing video. It was a heck of a video done on dividend yield and chasing a dividend yield, why you shouldn't do it, why dividend yields don't even matter. But I want to get to that a little bit later, because first I want to ask you, Matt, about your story. You have an incredible story. You've been investing for about 15 years. And of course, you found your way into the Bitcoin world, then into growth stocks before you got into dividend investing. So I got to know more about your story, how you got into dividend investing, and just, I guess, your story in a nutshell. How would you go ahead and share that with us?
Sure. So, I think my story really starts when I was unemployed. So I kind of talk about this a lot because really the first step to investing is to have enough money to invest, right? And I got to a point to where I was laid off of my initial professional job kind of out of college. And so, at least for me coming out of college, I had no money, no savings, no investments, no job prospects, basically. And I remember I was paying my next month's rent with the last of my unemployment benefit. And I was just kind of like, yeah, probably time to do something different with money. I should probably get better at this thing. And so, from there to investing was basically just doing whatever I could to try to get a good job, get some income. And I think I always kind of talk about, that's lesson one for anybody, right? Like anytime people are like, hey, what should I invest in? It's always, are you financially stable, right? And if you're not, that is always step number one, because there's just not much you can do if you're struggling to kind of pay the bills every month, right? So that's kind of the first thing. So after that, my investing journey really started with index funds, right? Because I didn't know anything and tried to save for retirement after I got that kind of initial good job. And I'm a researcher, so I look online, I read books, I do all this stuff, and all I heard was index funds are low cost. Warren Buffett says everybody should just put their money in the S&P 500 index. And so I'm like, yeah, I don't know any better. That sounds great.
Sure.
And so that's what I did for a long time. And I concentrated on getting my income up, which again is a great basic lesson for everybody, regardless of what you're investing in. The more income you have, the more you can invest, the better it's going to do over time, right? That's just basic math.
Simple enough.
Yeah, exactly. So after I got a foundation kind of built in index funds, And, it was one of those things where I just kept reading about investing. I read a bunch of books. I looked online, reading blogs, anything that I could do. And, you just kind of get interested in doing a little bit more. And we were finally in a position from a financial standpoint to where we could. So I got into, individual stocks. And, at the time, especially with the job that I was doing, I was working at a financial, or like a Fortune 100 bank, basically, but I was working in payments and payments technology. So everything that I was around was all this stuff, right? P2P payments, and then Bitcoin and all that stuff came up. And so it was just almost part of my job to look into it. But then I also wanted to invest as well. So I got into a lot of the like crazy growth stuff, Bitcoin and crypto from like 2014, like crazy, like totally different times than now in terms of, I was putting my personal information into, sketchy websites that probably I would not recommend anybody ever do ever. But that's just kind of, the time that it was. But
Sure.
that's kind of how I got started in terms of getting into stuff outside of index funds. And I learned a ton of lessons, both good and bad. had a lot of wins and a lot of losses with that method. And eventually, over the last few years, have come into really appreciating being able to invest in dividend growth, which is kind of my primary strategy, because it fits with my mentality a little bit better. And we can talk about that a little bit more if you want.
Sure. We're definitely going to get into that because, this channel is all about dividend investing and, of course, understanding the dividend investor's mindset and strategies. But I do want to go back to this moment where you got laid off, because before we jumped on here, we were talking about, really about resiliency, right? No matter what happens, it's like you're getting back on the horse and you're going to, whether it's YouTube and making videos or investing and you're putting money in the market, you're going to get knocked down, but you got to stand back up. So it sounds like you have the resiliency, or you had it, right? What's interesting is that at least a lot of people that I know, once they get let go, it's kind of like, wow, their white flag goes up and that's it, right? It's like moving back in with mom. They don't really put together this plan. It sounds like for you, though, it was quite different. It was like reality check. Matt wakes up and all of a sudden is like investing into index funds. Now, I likewise with you, I started off with index funds. My first index that I invested into was VTI. It is still the foundation of my portfolio. I think an exceptional fund, one that I will never sell. And, I started off with that fund because, like you said, it was safe. And it allowed me to really feel like I can build this firm foundation for a great long-term investment portfolio.
Yeah.
But then it sounds like you got bored. And instead of taking that route of just continuing to double down on the index investing, you started to invest in individual stocks. And I don't think at that point in time it was dividends, right? Dividend stocks.
It was not. No, it was not.
Where'd you go from there? And what was like the moment for you? Because this is interesting for me, right? For me, it was like, I tried like 2 or 3 growth stocks and I didn't have success. I needed the failures. I didn't have success. And then it was like dividend investing. That's the way, that's the route. What did you get into? What failures did you see, or like what launched you into dividend investing?
Yeah, so it's funny that you say, that you got bored, because I do think that does happen, right? From time to time. Index investing is so like it's so easy to be successful, right? Which is what's great about it.
Sure.
But if you're a person like me that's researching every day and doing stuff, it's like you kind of want to feel active, like you're doing something. And so I think that was definitely part of it. I think the other part of it was, it was just something I was interested in. And I'm, reading books by Peter Lynch, who I'm a huge fan of Peter Lynch. And One Up on Wall Street is one of the books that really got me interested in wanting to invest in individual stocks, right? Because here was this guy that he, led the Magellan Fund and all this type of stuff. And, everybody online is always telling you that you can't beat the market. You shouldn't even try. And here's the guy that was, actually leading the Magellan Fund, basically telling you, oh, no, you can. It's actually not as hard as they are telling you it is. And, here's some ways that you can do it. That was fascinating to me.
Sure.
And, it's fun to look at a company and say, I believe in where they're going and I want to be a part of that. So I made all the mistakes that you made, though, too. So, I got into growth stocks early on. I don't know, Snap is one that I can bring up, which, oh man, that one is just god awful performance forever. But in my mind, I was like, I have two kids, and Snap, and all of them are using Snap, and it's this company that's gonna be the future of messaging and all this. And so a lot of what I was doing was more art than science, right? I do still think that evaluating stocks is both art and science. But at that point, it was, what I was doing was way more like, hey, I saw this on a Reddit board and I like this company, I'm just going to buy it. Like, it wasn't really doing any due diligence or anything like that. And this idea of, I only want to invest in growth because that's what matters, I think is easy to get caught up in, right? Because you're starting out, and a lot of times, at least I did anyway, I started out with a smaller amount of money. And so you're like, how can I make this into a big amount of money? Sure. And it's, well, growth, right? This thing was 100x. That's what I should invest in. And so I think it's easy to get caught up in that because, obviously people are investing mostly to make money or to build their wealth. And so when you see something that, hey, this can take my wealth from 1 to 100, and this other boring thing can take it from 1 to 10, I'm gonna go with this interesting thing over here, right? And sometimes it ends up okay, and a lot of times it doesn't. But yeah, so
you only have
the growth
one.
Yeah, well, yeah, exactly. The problem with those is, yes, you may hit one. The question is, will you know when to sell, right?
Yep.
But so that was kind of my growth story, to where I was in a bunch of different stocks, and in some cases they worked out well. Like, I was in Meta for a while. It was prior to it being Meta, obviously.
Sure.
But then I had the ones like, Snap was terrible, and some other ones, and I really didn't have a strategy. It was just, I was just trying stuff and just putting money here or there, and I didn't really know what I was doing.
Yeah, I love it. Look, I was right there with you, in the beginning of my investment career when I got into those, growth oriented stocks. For me, it was Cathie Wood, right? Like, she picked Tesla, and Tesla was like the stock. And it was like, wow, she's got to know exactly what she's doing, every stock. And that got me really excited because, like you said, right, you start out with a small amount of money, and you want to grow it. You want to make something of yourself. You want to be successful. And so you invest it. And sometimes maybe you get, $200 plus or 500 plus, and you think you're Wolf of Wall Street at this point, right? And you're like, oh yeah, I can do this. Next thing you know, you're down 800. And so that definitely happened to me, where I've had an early, onset of my investing career, those learning moments where I was like, growth is great. It really is great. But again, you got to be getting invested into the high conviction growth stocks and taking a approach on those stocks where you're not saying I'm going to get rich by Tuesday. But I want to ask you your opinion. What do you think is it about stocks and, investing that makes investors kind of lose their mind a little bit, right? Like, just be brainless in this activity of, I'm going to invest, I'm going to, make 100x and, be the next Warren Buffett, and I'm going to do this all by next week. We literally lose our wisdom, we lose our brains, and we lose our money. Most importantly, what do you think is it about investing that that pulls us there?
I mean, again, I can only kind of speak from my own experience and just kind of what I've had in my own life. Anytime you put real money on the table, our emotions, I think, are different, right? And this is where, like, I've heard people talk about, if you like paper trade or all those type of things, it's like, oh, I'm like 100% hit rate, I'm amazing, because there's no risk of loss, right? And I think that when you start putting your money into something, I think initially, again, at least for me, like when I was starting out, when you see that something is going up a lot, then you start to equate that to, hey, my account could go up by that much too if I just get into this thing, right? Sure. And so you start kind of envisioning those gains before you ever get them, and that's the motivating factor to kind of jump in. And then, when it goes the other way, it's kind of this devastating thing because you actually lose real money. Sure. And like, I know I've heard people who are just like, yeah, I invested in 2021, and then 2022 happened, and I'm never going to invest again because, I'm down 80%, or, whatever the number is. But it's not even just with people who are doing growth. Like, I have people in my own family who have asked me, hey, what should I invest in? And I want to earn a lot, but I don't want to lose any money. And it's like, yeah, I would love to know that answer as
I
well.
hear you.
You have to understand that it is a give and take. Like, once you understand that there is risk involved, and you have to take at least some risk in order to get the reward. That's the whole kind of point of investing. But
Sure.
you also can't just take, unmitigated crazy risks because one thing went 1,000x one time. Right.
Yeah, sure. No, I love that. Look, I just think it's all over YouTube. It's all over really anywhere where there's ego, right? And it's like, I gotta make something of myself. And the ego says, if my brokerage account goes up, by 2x, 5x, oh, it's gonna keep going up. And therefore, this one's going to the moon. And I get, at this point, because I've had this lesson time and time again early on in my investment career. And if I'm being really honest, right, even within the past year or so, and, you lose money that way. But for me, those are lessons that are invaluable, because now, as an investor graduating from the University of Hard Knocks, right, it's like I almost needed to fail. I needed to fail fast, learn the lessons. I still can get tripped up in the emotions sometimes. Depends, on the stock, on what's going on. I'm not Mr. Perfect, as an investor, but what I will say is I typically will go into a position, not the dividend stocks, right? Because sometimes I do some swing trades, especially like, with the airlines not too long ago. I did a lot of swing trades, made a ton of money, and it was great. But I went into each of those swing trades actually with a walking point. And it was like, when the stock hits this amount, I will walk, or I'll have my girlfriend, hit the sell button and she'll walk for me. Right. It's like added security. What's a good walking point, do you think? Like, is that a good strategy, or what's a good walking point that you would use?
Yeah, I think you're making a great point, right? Of understanding what your goals are. And when I say that, it may not just be one thing for every investment you make, right? Like, if you want to YOLO into Doge or whatever you want to do, right? That's fine, as long as you understand what your strategy is. So the challenge, at least that I've had in the past, is that when I was learning, I would treat everything the same, right? Everything was the same. And it was like, yeah, okay, I'm, investing for retirement, but this thing that I want to invest in, I'm hoping it, goes up a lot. Whereas it doesn't have to be a mutually exclusive thing. You can say, look, I have my foundation that's building an index funds. I'm putting money away every paycheck, and it's just going, and that's my retirement plan, and I'm good, right? As long as I keep doing that. And then if you want to take a piece that you want to put into something extremely risky because you have a hunch and you're like, hey, maybe it'll go up, there's nothing wrong with that. Like, there's, if you want to take bigger swings and riskier swings, that's okay, as long as you understand what you're doing and you understand the risk that you're taking. My personal opinion would be, please have a foundation first before you do those type of things. But at the end of the day, each thing, as long as you understand what your goals are, it can work fine. Just like you said, right? If you know that I'm going to buy airline stocks because I think there's an opportunity here, and here's my number where I'm getting out, perfect, right? Whereas other people may be like, I just don't have the type of personality or temperament to do that type of thing, and I'm going to buy something like, Waste Management or Lowe's that's going to go up, with dividend growth for a long time, and I don't have to worry about it other than maybe just checking in every quarter. So a lot of it, at least for me, in like my own journey, has been understanding who I am and what investing style fits best with my personality, so that I don't get over my skis too many times, other than all the times I already did. And I think that's really helped me a lot, of just, okay, what works best with my personality, and that's what I'm going to concentrate on the most, and it's going to be different for all of us.
Sure. No, you said a lot of, insightful pieces that I want to nitpick now, because it's impossible not to go back to these, what I think are two really valuable points that you made. First of all, you mentioned the word foundation. And I'd love to know from your perspective, what is a good investment foundation to have? And then you mentioned getting to know yourself as an investor. And I think those both having a foundation, a personal finance foundation for yourself, perhaps, an emergency savings fund. I mean, there were crucial steps for me to feel safe to begin to invest. One of those steps, I don't know when I developed this terminology for what I developed now as my lemon fund, right? It's an emergency savings fund, but I call it a lemon fund because life happens. And so I'll have, the lemons to make lemonade, right? And so I
Nice. I
developed
like
this.
it.
I think it was honestly when I was back in college, I helped a lot of people with personal finances. I wanted to make it fun and exciting. I was like, you got to
Yeah.
develop a lemon fund, They're
No,
like,
that's cool.
what's that? But no, so I had a lemon fund. At that point in time, it was $10,000 for me. That would mean, I'm going to be safe, cover my bases just in case when and if life happens, I'll have that money, and then it was building this foundation in an ETF before touching individual stocks, whether it was growth, trying my luck there, and then of course dividend investing. But those, from both the lemon fund and the index VTI there was built up as my foundation. I really, feel like at least today when I look back, I knew myself well. I did let, at times the ego get the best of me because it's like, I want to make more money. Who doesn't? So that was the growth, aspect, the quick in and out. But then it was a very quick pivot into dividend stocks for me. How would you, again, recommend getting to know yourself? Whether someone's a beginner investor or a more experienced, how would you recommend we get to know ourselves as investors? That's one. And number two, what would be the foundation that you would recommend building for oneself as an investor?
Yeah. So in terms of the first question, right? The only way that I really know to get to know like yourself or how it worked for me is you just have to try different things. Like I think it's impossible to really understand how you're going to react to something just even by reading about it or hearing about it, or ideally we could all learn from everyone else's experiences and mistakes. In my personal experience, it doesn't work so well for me. Like I like to try it myself, and it's how I am able to kind of compartmentalize, my own personality in the moment as opposed to what I hear from another person who experienced it. And I don't know if that makes sense, but yeah. So you don't have to be extremely risky in trying things. It can be on a really small scale, but I really think that in order to really know what works, you do have to try it in your own kind of way that makes sense for you. But
Sure.
so that would be how I would say that. In terms of how to build a foundation, I think you hit the nail on the head. I mean, number one, emergency savings is absolutely critical. I think that is something that everyone should do even before they start investing, unless they're investing in like their work retirement account, which I think everyone should always do. The other part of it is I'm a huge fan of index funds, right? Even though I do a lot of individual stocks now, I mean, I built my foundation in index funds. They are an amazing invention, right? And I've actually talked about this on my channel. They are, allow people of any background, any knowledge level, any skill level, any interest level to be able to build wealth, right? And I mean, that's amazing just to hear those words out loud. So, if it's S&P 500, if it's VTI, if you're really about, dividends and you want to be SCHD, any of those type of things are great as a foundation. You can always get more complicated later. But I think being able to start there to where you're constantly putting money into it, to where it's building and you have a future that is building with you, I think is the first step. And, I'll just tell you, I have the most expensive air conditioner in the whole world. And it's because I didn't have an emergency savings fund. So I'll tell you this story.
Wow.
Hard, painful lesson. So I bought my first Bitcoin in 2014 because I was a payments guy, right? And I got an assignment at work that was like, hey, dig into this Bitcoin thing. And I did, and I went through all the stages like everybody goes through of, oh, this is going to be nothing, to, oh, it's kind of interesting, to, oh my goodness, this is the most amazing thing I've ever seen in my life.
Sure.
And I started out just buying some. I think at the time it was 200 and whatever a Bitcoin, a lot different than it is today. And I had a bunch of it and I just kind of put it away, just like, hey, maybe it'll be something one day, whatever. And we had one of our air conditioning units actually go out. And this was probably 2015 or so. And air conditioning units are expensive. I live in Texas, so they're expensive and they're necessary. So I didn't have a choice of having to, replace it. But I didn't have an emergency fund, at least not enough to be able to buy a new air conditioner.
I already
So I
know.
was like, all right.
Man, I just want to say sorry.
I know. So I was like, you know what? I shouldn't pay credit card interest, right? Credit card interest is bad. We all know this. So I was like, well, let me just dip into this, Bitcoin holding. I'll just buy it back over time. These classic things we all say whenever we, do these dumb things. And I was like, all right. So I liquidated, a good chunk. I mean, over 13 Bitcoin. I'll just tell you the number. It was over 13 Bitcoin. Which at the highest was, a 7-figure mistake.
Say no more.
So every time I look at that AC unit outside, I die a little inside, but it's okay. The moral of the story is,
are you staying cool at least?
yes, at least it works. And so we've had 100-degree days like every day for 2 months here. So it was probably in some ways money well spent. I just wish I would have done it a different way. So yeah. So don't be like me. Have a good emergency savings fund, so that you don't have to lose out on a 7-figure investment.
No, I can't even imagine. What comes to mind for me right now is I feel like I'm talking to the, one of the original employees of like Google or Microsoft or Apple who decided to walk away, and they're like, forget it.
Yeah.
The company's
the third Apple
anywhere.
guy, right? He sold his shares for like $500 or something. Terrible.
This is exactly why I started the Masters of the Market, series, because every single talk that I've had with a fellow investor, which first of all, it's I think key for everybody to note that we're just really the average Joes who are out there, right? Getting our feet wet, investing. We trial and error. We're finding out our strategies, what works best for us. And then once we find the strategy, it's like now you've honed in on it and you're making it happen, whether it's dividend investing, growth investing, for those who are out there, Doge or Bitcoin or whatever it may be, right?
Right.
However you can make money. But it seems to me, and we talked about this just before we started, right? Like there's all these connecting, I feel like, dots between everybody's stories where we're intertwining. And the biggest theme is the University of Hard Knocks. And that is always the biggest teacher, for us. And as we learn, right, as we fail rather, and then learn the lessons, now we're setting ourselves up to be more of, I want to say, a more, I would say, wise investor, right? It's all through experience. So some experiences are more than others, gotta say, right? But nonetheless, an experience. And I want to see, now, or hear from you rather, what were some of your biggest obstacles to investing? And, just this is the question before we're going to get into more of the dividend investing and, actual stocks here. But I want to know, because you've seen a lot of success, $225,000 just on the, your YouTube channel, at least the one you're showing on there on the account. It's very successful and it's been growing. And then you have your 401ks and your other accounts. So you've seen a lot of success. What were some of your biggest obstacles thus far in your 15-year journey of investing?
Yeah. So, it's a great question. I think, at least for me, the biggest obstacles always have to do with like myself, right? Sure. I kind of touched on it earlier. Understanding kind of what your goals are and what your strategy is, I think is important because it helps you from not kind of bouncing around a lot into different things. If you have a person who is into dividend investing and you have one who's into growth and you have one that's into crypto, whatever it is, right? If they're good at it and they've spent time really honing their craft, you can be successful in any of those paths, sure. Right? It just, when you start jumping paths because you're trying to get on the next hot thing, like that's when you just tend to not kind of go anywhere. And I think, at least for me, it's understanding, okay, what really makes sense for me and what works. And the other piece of that, I would say, and we kind of talked about this, beforehand, is understanding that nobody really knows anything, right? Like, I think we go into these things, especially when you're new to it, just being kind of naturally insecure about it, right? Like, hey, I'm new to investing. I don't know what to do. And what you find out over time is that there are obviously people who kind of know what they're doing and they're experienced, but there's also a lot of people who just speak more confidently than you do about things and really don't necessarily know anything, right? And so I think we're really lucky to live in a time when we have the internet, to where, any information that we want, any skills that we want to learn are basically available to us. And with investing, it's just like anything else. It's, if you put the time into it, you would be amazed at how much you can learn and just kind of understand in a short period of time, at least enough to get you to where you're a lot more comfortable. And I think a lot of times we get in our own way of just believing that it's this huge barrier that we're not able to get past because, oh, these people have been doing it. Like, I mean, even I talk about, oh, I've been doing it for almost 20 years or whatever. Okay, that doesn't necessarily mean anything, right? How many of those years were good years? Probably not 20, right? So, it's really just, we're all kind of on our own, path, and it sounds really cliche, but it's true. And I think the more that we can get out of our own way, of being afraid to ask questions, being afraid to act, other people criticizing us because they think we're doing something dumb. If you're able to get past that, then there's so many resources available to you to learn, right? Whether that's other people, whether that's information online. And so, at least for me, I was always a researcher, so I always dug into the information, but I struggled with, okay, but what is my actual goal other than, making money? I mean, making money is everybody's goal, right? When it comes to investing, but what are my real goals? Because the real goals aren't the number on the screen, at least probably not, right? I mean, we all might have a number in our head that is a number that's meaningful for us, but it's the reasons that make the number meaningful that are the real goal, right? Like, if I have 1 million or 2 million or 10 million, that's not really what's important. Now, if you want to give me 10 million, I will take it. Don't get me wrong.
It's coming back for that,
but it's right, exactly. But it's, I want to be there with my kids to be able to help them out and do their thing, right? Or I want to go walk my dog because he likes being walked. Or I want to be able to have my wife and my kids not have to worry about money so that we can do it. Those are the real goals, right? Wow. And so the more that I'm able to keep those in the forefront, the better I do, because I'm not worried that a person said, hey, you're an idiot for buying Apple at 194, right? Sure. Okay, yeah, sure. In the last week, maybe I've been an idiot, but over the next 10 years, I'm probably going to be okay, right? Because that's the real goals are attached to that timeline, not the, everything immediate online, like it is nowadays. It's just, we have this immediate feedback, which is great in some cases, but I think it hurts when you're talking about a 10, 20, or 30-year investment time horizon.
Sure.
So hopefully that makes some sense.
That makes a whole heck of a lot of sense. I wish we can replay that, right? Like almost like an NFL, like replay, just hear you say that again. I think that's so important because, yeah, we do. We get, so involved and heavily invested into the numbers on the screen and not our reality, which is right in front of us, which I think is such a beautiful segue into dividend investing. And as we talk more about it, I'm sure more of this talk will come up, but I want to, share it's advice from my father, actually, that I received when I was very young. And I was always, a very, say, philosophical thinker. I was always asking questions like, what's the meaning of life? And like, I was that kid. So for me, it was like dreaming big was, and I think I wrote even a LinkedIn article way back when, and it was like something, it was like dreamers are dreaming, something like that, right? Like just about dreaming big and try to stop me. And I'm sharing this because, this article in particular blew up, and I was so happy of this, about this article, and showed it to my dad, and he was impressed. He said, there's one thing when I read this article that's really going to be important for you as, you go about the rest of your life. So he really hooked me in there. He was in sales, by the way.
That's a
good hook. And I'm really listening in, and he goes, you need to know that in life, whatever gets measured gets done. And
Absolutely.
therefore he asked me after that, what are your goals? And my goals, at that point in time, like 17, 18, I'm like, I want a big house. I want a
Sure.
fast car, and I want to,
Yep.
whatever it was. And he's like, yeah, but how much does the big house cost? How much does
Right.
the car cost? How much does the yacht cost? Right? These are all the things I wanted. That today,
Yeah.
to be honest with you, I actually don't want a massive
Sure.
mansion, right? I don't. I
Yeah.
wear very simple clothes. My girlfriend and I talk about this all the time. If I had 10 million, $50 million right now, I still wouldn't be wearing Louis shoes because those it's just not my style. It's not who I am. And I'm
Right.
not
Exactly.
here today to try to impress anybody. However, I can tell you, at least at this point in time, the type of house that I want, how much it's going to cost, the car I
Right.
want to be driving. I can tell you the most important thing for me is going to be, providing for a family and being able to, like you said, right, walking a dog and, putting more time with kids. And I think
Right.
like that's the real value of what we're doing as
100%.
investors. And don't get short sighted with that number on the screen long term.
100%. 100%,
So,
dude.
so beautifully said. And I want to thank you for sharing that. I think it's one of the most highlightable comments I think ever made on a Masters of the Market chat. So thank you
Oh,
for
thanks,
that.
man.
Yeah, of course.
Hey, a real quick, because you said that you're a philosophical guy. I have a funny story for you because I'm also a philosophical guy. And when I first went to college, I didn't know what I was going to be, like what, major I was going to major
Sure.
in. And, I had a couple classes. I had like an ethics class and, a philosophy class. And I remember I went home one day and I told my dad, I was like, Dad, I figured out what I'm going to major in. I'm going to be a philosophy major. And he looked at me and he was like, yeah, no, you're not. Try again. And at the time, I was like, what do you mean? Now, in hindsight, that was great parenting on his part. I ended up going and doing computer science, which ended up being much better for me.
Sure.
But, dads are great. That's kind of the point.
That's
But
the point being made. Dads are great. Philosophy is exceptional, but not for a major. No.
no,
There,
exactly. It's, you know what, you go get a good job and then you can philosophize all you want on your own time. So I was like,
what
okay.
I always share, and again, I love these talks because it goes anywhere, right? But what I always share, I have a couple interns who just started for me, and they're all over the map. They're like just freshman year, just starting off. And what I share with a lot of people, because I just watched a documentary not too long ago. I forgot which banker it was on, but the banker was a philosophy major, right? So it's like it
Nice.
really all comes down to what you're learning and how you take away and apply what you're learning. For me, I actually started off in political science, realized, I initially wanted to get into politics, and then I quickly
Yeah.
realized I don't want to get into politics. And I went into
Right.
actually history and economics. But, for me, it was like, okay, I didn't get a job that really had anything to do with history nor economics getting out of school. I got into sales and marketing like my dad. But
Right.
I started off there, and then I got into real estate working for a great firm in Manhattan. And now I'm, head of marketing at a financial company. So it's like, for me, do what you love to do, the thing that's going to give you a lot of freaking passion,
Right.
and become the expert, in that field to the best that you can. Learn like a sponge and then apply it, because I've learned how to apply history and economics to sales and marketing, and it's been
Oh,
a
for sure.
beautiful
Yeah.
journey. And I've learned, especially talking about dividend investing now, right? Like history repeats itself, a classic lesson that you can apply to investing, which is why I also love history. But on this note, Matt, I want to head into now talking about some dividend investing, some good old
Yeah.
dividend investing. So we
Absolutely.
know we know you had your Bitcoin, saga. What most would say is, a letdown. I'll say is a let up, because I think it taught a great lesson, and it really, I mean, if anything, probably fired you up to double down on a strategy that works well. For me, that strategy has been dividend investing, and I think you've seen a lot of success there as well. So a let up, and you've had a journey with growth stocks, of course, ETFs and indexes. What was for you the turning point into dividend investing that made you realize that this is the strategy that fits you and that you're going to deploy?
Yeah. it really is around kind of the mindset. And maybe this is just, me whenever I buy a dividend stock as opposed to a high growth thing. But it was really a shift in mindset from being a consumer to being an owner, right? And what I mean by that is, when you're growing up, you think about you were just talking about the things that you wanted, right?
Sure.
We think about the $100 sneakers that we want. We never think about being able to start an apparel company, right? We think about the $5 coffee that we want, but we don't think about owning the coffee shop, right? And it's these things that just as we grow up, or at least how I grew up, or how I think a lot of people grew up, we don't talk about money in that way, right? And so what I love about dividend investing is, at least for me, my mentality going into it is I'm buying a piece of a business that I am now an owner of, right? And so as this business does well, my dividends come in, it grows as the revenue grows. And the idea is that I'm there with them, right? And so my criteria has gotten a lot more strict. Like in the past, if I was just trying to jump on a, hype like stock or something, I wasn't really doing any kind of due diligence. It was, maybe hey, this looks cool, or, the future is here, or, whatever. Whereas now it's, hey, this is a business. Like, I am putting my money into part of a business, and I'm going to evaluate that business. And does it kind of, match with what I think a good business looks like? Or, a lot of what I'm concentrated on now, kind of my general strategy is I want to attach myself to companies that have wide moats, that are increasingly generating cash and distributing that cash to shareholders in the form of dividends with a growth rate that outpaces inflation. That's my general strategy, right? And the idea there is, I think at this point I have maybe 10, 11 individual holdings. That's probably going to be the max that I have, or actually it'll probably be less than that, right? Because ideally what I would love to get to is I have a handful, or maybe a little more than a handful, of really great companies that I'm part owner of that business. And they're paying me, dividend income based on their business continuing to be successful over 10, 20, 30 years. Now, that's probably not going to happen with every single one, right? And so that's why we always have to keep, monitoring and evaluating to understand when that story changes. But I'm going into the investment with that mindset, which I had never done before. Sure. And so that fits with my personality a lot more, because I kind of mentioned, I think, a couple of times, like, I'm a researcher, like I love to dig, and it's worked better for me because I'm less trying to be active and do something, right? Sure. The activity happens up front in my evaluation, and then I just try the best that I can to not do anything, just sit and wait, sure. Which is tough. But sure. That's kind of my mentality. It's really that switch from being a consumer to being an owner, and dividend stocks just naturally kind of make my brain go there. So that's why it really works for me.
It sounds like, it's right out of the book, or reminds me very much of the book, The Millionaire Next Door.
Yeah.
Because it really
it's a great book.
Fantastic read. But it's like this mindset. You have to, I feel like, to be a good investor, right, is to become your own, if you will, CEO or CFO. Because it's this mindset of being a consumer versus being the owner is so drastically different. And it's interesting that you brought all those points up, because that's actually a huge switch that I had early on in my investment career, where it was like, wait a second, like, I have a MacBook computer, I'm buying Apple iPhones,
right?
Why don't I own any stock, right? Like,
exactly.
Why am I going to go to, Starbucks and get the coffees, with my girlfriend, but never invest in the actual company, so on and so forth. And once the mindset actually switched, I started investing into the company instead of the product. Right. Oddly enough, I stopped buying the product. I just started pouring more money into the company.
Hey, that's good.
And, like this was always my deal. It was like, instead of buying the newest iPhone, I always bought the last generation. And then I would actually treat myself to another share or two worth of the Apple stock. That's what I used to do. And
that's a good strategy.
A fun way to be like, yeah, like, I don't need the newest phone, I want more Apple shares, right? And now Apple's one of my largest individual stock positions. But I love that you shared that. What would be the second step that you feel? Because it sounds like the first step is like looking around, the products that you're using, and then you're looking to the companies who's behind the products. What's the second step? Because I mean, let's take like, this is almost beating this one to death, right? But like an AT&T or something, right? Like it's like,
Yeah,
oh,
sure.
my phone provider is AT&T or Verizon, so I'll look into these stocks, but they're really not high dividend growth stocks. What's your
Right.
process like in terms of the next steps?
Yeah, and that's a great question because it's changed a lot. Because I did exactly that. Like I held Verizon for a little bit, and I mean, I recently did a video where I mean, over the years, my evaluation criteria has evolved and hopefully gotten a little better. And I actually did a whole video about how, yeah, no, it doesn't look very attractive depending on what your goals are, right? So, um, I do think that it's okay to get started with something that and I know that isn't always popular because people are like, oh, what might not be a good stock. I think if you're starting out, that's okay. It can be a lesson that you kind of learn along the way. I think the after kind of having the idea of I'm going to change my mindset, I think being able to stay interested in the things that you buy, whether it's because you really researched them a lot or because you personally enjoy the product, I think is just as important, right? Because the challenge that I've had in the past is you might hear about something, maybe it's a company or whatever that you buy because you read something about it, but you don't really understand their business at all, and it may not even be a product that you use, and that's okay for some folks. But I think if you're starting out, half the battle is just staying engaged with investing and not getting, I don't want to say bored because it can be boring and you can actually be very successful when it's boring. But what you don't want is to be like, hey, I bought this thing that I know nothing about and it went down 20% and I'm going to get out of this thing, right? Because
Sure.
I don't know what it is. And
Sure.
so I do think there's value in saying, I do know this company and I like them. And then evolve your evaluation criteria. And it's going to depend on what your goals are because like let's say you're closer to retirement or something and what you really are looking for is I want dividends, but I want them to be steady. Ideally they're growing, but they don't have to grow at 10%. But I want a company that's maybe has a 50-year history of growing and paying dividends, and maybe they have low debt so they're not at risk of or a low payout ratio, maybe that's a better measure. And so it's these combination of things depending on your situation. So I don't have a great method of here's exactly how to learn your method, because even in my own story it evolves maybe not every week, but as I learn more and I see what, hey, that person's doing and they're looking at this and I'm like, yeah, that doesn't really fit with what I'm doing, but what I saw from this other guy, wow, I never looked at it that way. And so I think it's this constant kind of evolving and living thing. But the main thing for me is that I've stayed interested in it. Now obviously there's incentives to being interested in it, because if it does well then you build wealth, and everybody wants that. But I also think we have to find ways to stay interested in it even when it's not going so well, right? um, like if I look back at 2022, I had some things that were very good investments and I had some things that were terrible investments. Like I was, in a couple of Bitcoin mining, stocks in 2022, which
Glad.
was maybe the absolute worst place you could have been in some cases, right? And so I think that's kind of the difference of, in hindsight, those were terrible mistakes because I hadn't really locked down my actual criteria that I use to say, hey, this is what a good company looks like, as opposed to just like that's the balance between I'm interested in this and I'm interested in this and I'm going to put my money into it,
Mm,
right?
sure.
Um, because had I been, better at that time, and I mean, again, there's always winners and losers, right? So it's, you have to take from the losers, well, actually from both, but what hopefully you take from the losers is, how can I not make that type of mistake again, right? Like what did I not do that time, and I'm going to do that next time. And it doesn't mean it's going to be perfect. It means that you've built another brick on your criteria method, and over time it should hopefully equate to better returns, right?
Sure. No, it's a great answer. literally didn't expect anything less than something exceptional as such. And, this leads me to my next question for you, because you talked a lot, you mentioned the word boring a lot when talking about investing in certain stocks. And, I just looked at a quote today. I think it was a George Soros quote, that if investing is fun, you're probably doing it wrong. And I love that quote because it's
Yeah.
so true. It's like, I'm not here to have fun. I'm here to be a business owner, like we were saying before, and
Right.
make an investment into a company to then hold on to for the long term. And hopefully by the end of that term, fare far better off for having invested than not having invested. But sometimes the market goes down, or sometimes the market's flying high, and holding a Procter and Gamble is just never going to be that fun, but it's going to be lucrative.
Right.
Because
100%.
it's stability, reliability, and dividends, and safety, and share price appreciation. If you look at P&G over the last decade, it's done phenomenally well. But this whole concept, right? I think it's such a killer. Get rich by Tuesday, right? Go all in on growth. And,
Yeah.
because the reality is, for me at least, especially as a dividend investor, and why I love dividend investing and growing and rolling this dividend snowball, is because I'm actually seeing my wealth over, on a monthly basis, really, as I track my dividends. And that, there's nothing more powerful than that for me, because I'm literally watching myself grow richer month over month, and
Yeah.
knowing as well that on a month over month basis, I'm not doing that much work, right? What am I buying? A couple shares here and a couple shares there, and I'm investing for the long term. It is boring, but it's lucrative.
Yeah.
So I love that you shared that. Now, I also loved, you started talking about your personal portfolio there. The one that, at least that you show, I think, on screen, is the, what, 10 to 12 position portfolio.
Mm-hmm. Yep.
So I will, and I'm always, as transparent and honest as I can be, because I want investors to be able to learn from my mistakes. That's
Yeah.
wisdom. You're able to not make the mistakes I made. One of the mistakes that I personally made was actually in 2020. When every stock was so beautifully discounted, and I loaded up my portfolio with as many holdings as possible, because that was like, a shopping spree for me.
Right. Right.
Soon after I loaded up, I realized, well, it's not so cute, I guess, to have 3 shares of X company and I get paid a 56-cent dividend. That's not that exciting. But what's great, right, that drives me as an investor, or even, right, just building a quality position and getting a bigger dividend paycheck at the end of the day, is going to fare me far better off. So I ended up watching a Bill Ackman video,
Mm-hmm.
and he was talking about having 10 to 12 positions, if that. I think he's got 7 now in the Pershing Square portfolio. But
Right.
find the best, and I mean the best, right? 2 to 3 high quality investments, because at any given time, there's only 2 to 3 of them out there. Who are we kidding? And then you can pack on some moat worthy investments as well. But like, really, there's going to be
Right.
2 to 3. And I go, huh. I looked at my portfolio. I had like 40 to 50 holdings, and I started trimming. Now I'm trying
Yeah.
to get to where you're at 10 to 12 positions.
Yeah.
Can you talk more about that strategy, how well it's been working for you? And is there a right amount of holdings to have within your portfolio?
Yeah. So to answer the kind of the last part, again, I think it's going to depend on your own individual capacity to be able to deal with them. What I've kind of noticed with myself is where I'm trying to improve is the level of depth in my understanding of the companies that I hold, in the, I guess, the what you had called the walking points, or like the levers that I'm really looking at. Like, why did I buy this company? And is that story intact still? And as long as that story is intact, then I still want to be part of that company, right? But if it changes, then maybe that's when I need to revisit. And so what I've noticed is that as my kind of process, or method, has gotten hopefully better over the years, it's harder to be really knowledgeable and really good at, you know, 80 companies, right? Because each company's in an industry that you have to know at least a little bit about if you're going to evaluate them, right? And so what I found is that being able to concentrate on 10, and I would argue even 11, 12 is hard at times. But it's easier for me to get more depth on each one so that I really understand, like, let's say when the earnings report comes out, like a great example is I bought Walmart, which is usually not the type of company that I would buy. I actually made a whole video about how it didn't meet any of my criteria and I bought it anyway. And it was because, Walmart from a dividend growth perspective has been abysmal. From a free cash flow, margin. I mean, they're, one of the lowest margins because they're, retail and they're discount retail, right? But anyway, but the story that I saw with Walmart was that they were, had, made a bunch of investments over the past few years into technology and other things. And they had planned to start realizing that here, over the next however many years. And so my whole investment idea into Walmart, or, was the dividend growth isn't there now, but their revenues are growing at a decent clip, higher than other, retail outfits are right now. Sure. And their income and free cash flow is growing at a higher rate. And that's what they expect over the next however many few years. And it's looking at earnings calls and transcripts and all that stuff. And so when they had their last earnings call, they were talking about that exact thing, right? They're like, hey, our revenues were up, over 5% or whatever, but our net income's up even more, right? Sure. And so even though the price maybe hasn't gone up a lot, I think it's gone up a little bit, but the story of why I invested is still there. And I'm hearing the management team actually talk about the things that I had in my thesis when I bought it, right? So I'm trying to do more of that type of stuff where I'm getting more depth on the actual companies that I buy. Because again, we talked about, if you're truly an owner of a company, you should probably know how they're operating, right? Yeah. And again, I mean, that's just the way I'm doing it. Like, everybody has their own, method. And for other people, it's, what, I'm going to go with all the dividend kings because they've shown that, history and, that stability. And, that's fine too. But for me, it's, I want to get the level of depth in each of these companies so that anytime I hear an earnings call, I can easily say, okay, the type of things that they're talking about, the numbers that they just published, that story of why I'm here is still there. And sure, if it is great, then I wait. And, the market may price the stock at whatever. It may not agree with what I thought the reason was to buy, but hopefully over time, it matches up with the success of the business, assuming that they're performing well. So,
wow. So insightful. I really have to say it's I can just keep listening to your, what I feel like is a great journey that you've had, full of experiences, like very rich experiences. I just love how you keep even mentioning, how you've evolved and you're evolving, right? And it's like you really are, I mean, truly a researcher, getting deep into the research, understanding. And that, for me, everything you just described, right, is exactly why I began trimming my portfolio, to really gain a better perspective and scope on, like, what if I'm going to be the CEO, right, or the CFO of, Ari Gutman, right, or like, Ari right, Gutman's going to become a part of X company. I have to know the ins and outs of this company. And there is no way that I'm going to be, 80 companies deep and know everything that's going on with all these companies. So I love that you mentioned that. Did you ever have at any time a portfolio that had 15 to 20 plus positions?
I mean, yeah. So absolutely, right. I mean, I had a time where I kind of did what you were doing, where I had a bunch of different companies because, I was interested in a bunch of different companies, but sure, but I had kind of small amounts of all of them. What I've kind of tried to do is, mix the individual stocks with the ETFs, right? So like, even in my my dividend portfolio now, a big part of my holdings is SCHD. Like, I have maybe 20% of, my holdings in SCHD. And why I like that is because, again, I can't monitor the 100 stocks that are in SCHD, right? But I do know the criteria that ETF uses to be able to evaluate, well, it's the index that has the criteria, right? But it basically tracks the index. And because my investment goals align with the index's criteria, I can just say, yeah, okay, you know what? This 20% is going to be in this ETF because I don't have time to be able to get any depth on those 100 stocks, but I believe in the method that they're using. So that's a little bit of a hedge against my own ignorance, right? So it's, I have these other 11 stocks that I'm actually trying to dig into deeply, but I also have this ETF that, specializes in undervalued dividend growers, and that is kind of my strategy. So I'm kind of doing that as well, right? And I do think that that helps, because sometimes it can be overwhelming, especially if you're starting out. You're like, hey, I want to get into individual stocks and I want to buy all these different things. You can just start with, have an ETF that kind of, is along the same investment philosophies that you are, and then start with one or two or three individual stocks until you really get the depth or the confidence in kind of what you're doing and in your method. And there's absolutely nothing wrong with that, right? So it's nice because I never worry about SCHD. Like, I might look at it, anytime that they update the holdings, just to get an idea of what's in there, now compared to last year. But in general, it's more of like, okay, I don't need to spend a lot of time mentally monitoring that. It's there and it's growing. And as long as their performance kind of matches what their criteria or the actual method of how the index is, picking stocks, then I'm okay. And I'll concentrate on these individual holdings to hopefully get enough depth there.
Sure. Do you dollar cost average into SCHD, or the 10 to 12 positions you have, or when exactly like do you strike on these positions?
Yeah. So it's funny because I've been talking about this on my channel, because the last couple buys that I had on my channel had a lot of fun comments about, oh, you bought the top, oh, they're overvalued, all that type of stuff. And so I would say it depends. I'm not dollar cost averaging into SCHD right now. And actually, it just kind of depends, as I have money going into the account, if there are holdings that I have in my portfolio that I think are still at a kind of, a value price level, then I'll just kind of add to them. Yeah. If there's none, then I won't. But like the last two things I bought were Apple and Visa, right? And then Apple, I had multiple videos about my journey with Apple, of how I never bought it because it was always overvalued and it was this kind of ridiculous thing. And so I ended up buying it at basically the top. It was like 194, and I made this whole video about, bought Apple at the top and here's why I bought it. And people had a field day with that one, because they're like, oh, why'd you do that? That's so dumb. And I explained why, and everybody has their own methods. But the point that I was kind of trying to make was, there's going to be companies that when you look at them in a traditional kind of valuation method, are always going to kind of look overvalued, and there's always going to be kind of like a premium to be paid. Sure. And all of us as individuals have to decide what we're comfortable with and what we're not. Now, could I have waited and played the numbers and done it? Absolutely, I could have. And in hindsight, that would have been the better play. But I looked at it as, this isn't a 8-month hold for me. This is Apple, right? This is probably a 10-year hold, minimum, obviously depending on how they do. But so what price I paid today, it doesn't bother me as much if I'm assuming that it's truly a long-term hold. And Visa was the same. I mean, Visa is one of those where, if I looked at the price, today, they're, close to all-time highs, right? And so anytime a company gets to close to all-time highs, everyone's like, oh, it's overvalued. But in my diligence, and I was looking at their historical price metrics, actually their price earnings and price to cash flow have been going down since 2021, right? Which means that the business has kind of caught up to the price a little bit. And, I mean, we're looking at Visa, it says, 97% profit margin, their free cash flow margins over 51%. I mean, it's just ridiculous. Sure. And so from, my standpoint, again, here's a company that I'm going to hold for years. So why do I care if it's at an all-time high? Now, I'm not saying everybody should do that. And I know that a lot of folks use valuation as kind of their core thing. I have it as a core part of my criteria, but I weigh heavier on the kind of business outlook and business prospects and moat, as well as the operational performance of the business, than I do valuation. It's more of, if I have a business that I think is great, and they have a wide moat, and they're performing well, then I may just buy, right? Regardless of what the price is today, as long as it doesn't look like it's some just outrageous, like 2021, everything is just completely outrageous in terms of valuation. Yeah.
It's like
But
it just reminds me of Buffett, how he shares how you shouldn't be looking like, yeah, he looks at valuation. Of course, Buffett's looking at valuation, but what
yeah,
he's also really doing is looking at the business and asking himself a fundamental question. If the market were to disappear, would he still be interested in taking part in ownership of that company? And I mean, talk about a steady hand in investing, right? And it's that approach, that very approach that's being used. And I also have a story for you here because I think you'll love this one. You'll appreciate this as you're also a big Apple investor. So, my uncle, who we spoke about just before we jumped on here, was a Fidelity money manager, and he managed a
nice.
lot of their ETFs actually. At one point, at his prime, he was managing about $25 billion. Um,
Wow,
and
that's
and then he
amazing.
yeah, his early career, he started off managing 5, then 10, then 15 billion, and then at his peak, he was 25 billion. But so I always remember going to his house. They lived in Boston, my cousins, my family there, and we'd always go, and he would always have, and I share this, a few times in different Masters of the Market chats, but he'd always sit with a newspaper, and he'd be looking at ticker symbols and looking at what's going on. This was the early 2000s, right? So the huge paper that's out, and I always watch him because again, it's like you're a young buck, right? You're a young kid, and we'd go to his house, and he had this grand house in the center of Boston, like big, beautiful
Nice.
house, right? And it was like that's the mansion, right? Like that's probably where I want a mansion, right? But he, again, another very, very humble guy. You'd never know he was a wealthy guy, but you know wow, loaded with knowledge, insights, and interestingly enough, I mean, the safest of safe investors never got into anything other than indexes and ETFs and built himself
Nice.
quite a nest egg. So for those of you who are out there saying ETFs won't get you wealthy, I mean, this is just one
Yeah,
example of many. But
100%.
when I had asked him, and there this we can all go back into deep into the master of the market files to find the video and the question, right? When I asked him what his greatest investment was in the market, he actually shared that it was stock advice that he got from his son, my cousin, to invest in Apple. And my cousin, but he's a year older than I, so early 2000s, right? We're in our teenage years, and he goes, I love Apple. That's the stock I want to pick. So
Yeah,
my uncle took his bar mitzvah money and put it into Apple.
nice.
And he says this has been the greatest return on investment that he's ever had as an investor. And he's managed $25 billion for Fidelity.
Right.
And he said, right, and he still says to this day, every time we talk and laugh about it, Apple was quote unquote, overpriced then too. But
Yeah.
it's going to depend on how long you're going to hold the company. So I had to share that because
Yeah.
I hear that so often where it's like, oh, that company is overvalued. Or it's like, yeah, yes, but also when you take a company, right, like maybe it is a P&G, a Visa, an Apple, a Microsoft, they are hardly ever going to be undervalued companies. Like, unless you get the
Right.
one-off event in 2020,
Right.
March 2020th on the 20th at 3 p.m., and boom, Apple's at its lowest point. But other
Right.
than that, it's Apple has fared me very well, and I've built a good strong position with Apple, just like you are, and it's only fared me well because I look back 5 years, 10 years to when I started investing into it, and here we are today. But
Yeah.
this now I want to jump into how much you're actually bringing in on a monthly basis from the dividend investments that you have.
Yeah. So it's a good question. I know that my portfolio yield right now is about 2%, which is about where I want it at this like stage. Because I'm really concentrated on, growth. So, most of my companies are, 1 to 2% dividend yield. I think the only ones that are over 3 are Valero, which is a company that I love that's actually done really, really well this year. And then I think like SCHD is obviously over 3, but I think everything else is I think between 1 and 2, and then obviously like Apple and Visa are under 1.
Sure.
So it's about 4,500, a year. which, people hear that and you're like, oh, you have a, 225K portfolio, you're only getting 4,500 a year. But right now it's by design, right? It's
Sure.
more about, I want those companies that have really good dividend growth so that by the time that I'm ready for retirement, then all of a sudden that 2% is a much higher, number. But yeah, that's about where I'm at right now.
I already saw the magic coming in. That's why I got this big smile, because I'm like, wow, that's called strategy, folks. It's like go lower right now. You're looking at dividend growth for your future. Yeah. And especially
it's
like
hard, man, because it is so easy to be like, hey, look at this company. And, a lot of times it can be a good company. Like, it's not like, oh, you have a high dividend yield, it's automatically a bad company. There's some quality companies, even right now, that, have 5% dividend yield. So it's very hard to be like, why don't I just go grab that right now? But,
sure.
You had kind of mentioned like the dividend yield video that I did. That actually helps a lot, because as I was researching that video, like, I kind of knew that that was the case, but even just researching for that video helped me understand how drastic the difference was when you looked at it. And in that video, I think it was only over a 10-year like time frame, right?
Sure.
And so it really helps to see that stuff actually visualized, to say, yeah, the yield looks great, but when you compound it over any period of time, it really is about, dividend growth. But anyway, I didn't mean to cut you off, man. Sorry.
No, this is actually literally exactly where I was going to go, because I wanted to understand how much you're bringing in monthly, and then jump right into the video that you just mentioned, which was the dividend yield video you recently produced. And I watched this video not too long ago, actually. I think I watched it last week, when I reached out to you for this interview. And then I actually, just before we jumped on, was watching it. Right now,
as thank you for that view. I appreciate that, sir.
Yeah, you got it, man. As of this recording, this dividend yield video that we're talking about is on Matt's, what is it, the homepage there for you? If you go over there to his homepage.
On the channel, yep.
On the channel, highly recommended. And basically the messaging of this particular video is that dividend yield just does not matter. And instead of me just explaining your video, I want to pass the mic over to you and have you share a little bit about why dividend yield doesn't matter and why it shouldn't be our big focus.
Yeah, absolutely. So, and I'm gonna start with the caveat that I put in my video. The case where it does matter is if you are in retirement or close to retirement and you actually need a specific amount of income, then obviously dividend yield absolutely matters in that case. But if you're an investor with a longer time horizon than that, then it doesn't really matter. And I've had this problem, in my own experience, to where you want to buy a stock, you want to buy dividend stock, and you're like, hey, Verizon looks relatively undervalued. Price to free cash flow is like 5, or, whatever seems like a low number. And they have a 8% dividend yield. I don't know what it is today. And so it's natural to kind of think, hey, let me put my money in this because I'm going to get a lot back. And I think people do this a lot with ETFs as well, right? Like, what's the highest paying or, yielding dividend ETF? And JEPI's one. Yeah, right. And JEPI's one I'm going to talk about this week too, but it's this idea of it's money in hand, right? And so it feels like maybe it's less risky and all that. And in some ways it, might be, depending on obviously what the market does. But if you have a longer time horizon, what you see is that dividend growth really is what makes the difference in terms of building a portfolio. And the example that I used in the video was Verizon and Lowe's, right? And if you went back to 2013, Verizon had like a relatively high dividend yield. I don't remember what it was now. And, Lowe's was like 1 point whatever. And so, it's not out of the realm of possibility for people to be like, I'm going to put my money in Verizon. But then when you looked at what happened over 10 years, now, obviously, as a company, Lowe's just performed better, right? So their stock went up a lot more. But the crazy part was, over the 10 years, you ended up getting more in dividends from Lowe's than you would have from Verizon, even though the yield was, multiples higher. And that's because as the capital appreciation of the company happened, as the dividend growth happened, they started giving you more of the profits. And, you go and you look at a dividend company and you say, oh, it's only paying 1.8%. That's low. I don't want to invest in that. but if it's the right company, that's totally fine. And part of what I also showed in that video is if you look at Warren Buffett's portfolio, he invests, almost all the way in dividend stocks. He probably has a couple that aren't dividend payers, but they're primarily dividend stocks. There's not very many of them that are over a 4%, dividend yield, or probably even over a 3. A lot of them are a lot lower than that. And it's this idea of, it's not just the high yield, right? It's, you want a company that is strong and is growing, and is the pace that they're issuing dividends and the rate that they're growing the dividends should be hopefully outpacing inflation, right? Otherwise, you're losing money, right?
Sure. Wow. There's so many questions I have, just the follow-up questions, because you're dropping so many, again, tidbits of insights and knowledge for dividend investors, beginner or experienced. I want to throw some actually viewer questions your way at this point, because
Yeah, sure.
as I've been doing these Master of the Market chats, what I've realized was, okay, number one, I decided to do these chats to, as we discussed before we jumped on, right, get to know the face behind the lens, if you will, because what I've, on YouTube, you see this all the time, right? It's like, oh, he can do it, I can't. And it's like, no, that guy behind the lens is probably the average Joe, and we just got started. That's the only difference. But
100%.
now what I've found was I have a lot of viewers that are watching these videos, and they have their own questions. And my channel, and I think so is your channel, it is literally there to help other investors. And so with that, one of the questions I've gotten now from a viewer to ask those who are joining me is, what is the recommended brokerage that you would use? Which one are you using now? And would you do anything differently? What's the recommended brokerage?
Yeah, so right now I use Schwab, and so that's I've been there for quite a bit, and I've recently just consolidated other accounts that I had other places into Schwab, because they have some portfolio tools that I like, and it's easy for me to be able to share my portfolio's performance against like the S&P with like my channel. And so it's been nice. I like Schwab because they have pretty good customer service, and they have all the different account types that I have. So I have like an HSA, I have like a business retirement account. And so it's this combination of things that I can all have in one place. I have used Chase in the past, which is fine. Like, they don't have all the advanced features that Schwab has, but it works okay, especially if you bank there. I've used Vanguard in the past as well. I think Vanguard works really well if you're going to stick with Vanguard ETFs and index funds.
Sure.
If you're really going to do stocks and all that type of stuff, I don't like, my personal experience is that they like hold funds for like a week before you can buy a stock. Like, it's just pretty ridiculous in 2023.
That is true. I'm a Vanguard guy.
So I'm just like,
100% true.
What do you mean? It says it's available.
Yeah.
But yeah, but I mean, obviously Vanguard is an amazing company, and like, my mom's portfolio is there, but again, hers is a lot less complicated than mine. So, but yeah, I use Schwab, and I've, dabbled in the apps like Robinhood and, Cash App and all that. To me, partly it's probably because I'm an older guy, but I don't know that those are the best place if you really want to build kind of a long-term thing, but obviously, like, to each their own.
Yeah, great answer. Follow up here is, or rather the next question from a viewer is, if you had the opportunity to buy one stock, right, that you just for whatever reason you can't right now, what stock would it be? So perhaps you don't have the funds, or maybe it's a stock that you don't know if it's going to go somewhere, you don't want to add it to your portfolio, which I almost feel like would be the case for you. But the one stock that you really, really want to buy and bet on, but you just can't.
So I'll go kind of off the beaten path here with it. So in terms of normal stocks that I would buy, I actually think it's the two stocks that I bought most recently. It's Apple and Visa. And I know those are extremely boring answers, right? Like, telling people that you'll invest in Apple and Visa is not going to convince anybody that you're an amazing investor. But that's kind of part of the point is, I actually, recently got out of my Waste Management and my Lowe's positions. And those are two great companies. So I want to caveat that. But part of why I was doing that is because I was trying to shift into businesses that I thought were even stronger and that were higher margin businesses like Apple and Visa, right? But my point is that those businesses are so strong to me that it's those type of businesses that I want to buy. And if I had more money to buy them, I would. But the one that's kind of off the dividend path, just because of my personal experience, and I have a daughter who's 11. Roblox is this unbelievable phenomenon with kids of that age. Like I just like have never seen anything like that before. And the whole I don't know how much you know about Roblox, but they have Robux, which is basically the currency in the game, right? Or in the world. And it's this like fascinating thing where she's 11, all of her friends played it, they've played it for years, and I'm curious to see how that evolves in terms of and I'm not even going to get into like a metaverse thing. That is a whole other can of worms. But there's a whole generation of kids who have been doing this for years now, and I'm just curious what that actually means for that business long term. I have no idea. I do not recommend you know YOLO your money into Roblox, but just from a anecdote, like just watching my daughter and her friends for the past few years, I'm curious to see where that one goes.
Hey, she could be right. It's anybody's game out there.
It's just unbelievable. It's unbelievable.
Next viewer question here. It will be our final viewership question for this show here today. But the three stocks that you would heavily invest into for the next decade, I feel like we already got Apple and Visa out of the way. So how about you just give us a third?
Yeah. So it would definitely be Apple and Visa. So the other one that I actually talk about a lot on my channel is McDonald's. I love McDonald's. It's just, it is one of those stocks where, like I've talked about it before. It sounds like a boring company, or people like, oh, McDonald's is gross, I don't like eating there. McDonald's has beaten the S&P for the past 5, 10, 15, 20, 25, 30 years in total return. McDonald's, like, it doesn't have to be this thing that is, this crazy tech stock or this, way out there AI company. It can be McDonald's, right? And what I love about it is I also have a lot of kind of personal affinity for McDonald's. I used to go there with my grandpa. I used to go there with my parents on road trips. I go there with my daughter now, and I share that on my channel. Now, again, I mean, not that we should be investing with our heartstrings, but it always helps when there's a great business out there that you also appreciate and have some experience with. It just helps, like when you're asking me what three companies am I holding for the next decade? Well, you know what? It may not be the best fundamentally compared to other ones I have in my portfolio, but it's going to be one of the three because I have that type of attachment to it. I probably would put Apple and Visa there as well. So, Apple, Visa, McDonald's, probably the most boring three that you've ever gotten, but I do believe in those businesses. And just from a fundamental standpoint, those are actually, I think, I'd have to look at what else is in there, but I think they're the three with the highest profit margins in my portfolio. So high margin businesses that grow dividends. So yeah.
No, all three are high quality businesses, as you just mentioned, very reliable dividends. And, most importantly is you can understand the businesses themselves and you want to be a part of the business, which I think is incredibly, important. Now, it's going to wrap us up here with two more questions.
Sure.
Now, this last one, yeah, I'm sure you've seen some of the Masters talks or some of my videos, and I'm always a big macros matter guy. And that's probably really the research end of me. You talk a lot about Peter Lynch. I got this mentality from Peter Lynch. So I love when people kind of, play it off like you shouldn't ever look at economics. It's like, well, if you've ever read any Peter Lynch, like he loved economics. He's all about economics. But that's besides the point. Let's go with some macros that do matter right now. And the macros that do matter right now is that we are a couple weeks shy of the Federal Reserve coming out and potentially hiking interest rates again. We could see a terminal rate that may hit, what is it right now? Over 6, and that's pretty alarming. Now we also have inflation that's been stubbornly high, but it's come down over the year and tremendously at, I think, a pretty solid pace. That's almost on par with what the Federal Reserve has been desiring. But nonetheless, right now it's at 3.5%. So again, we get that hawkish tone from the Federal Reserve. A Goldilocks situation with the labor market being robust. Right. And we got this big question. Will there be a soft landing? Will it be a little bit bumpy? Either which way, I think what it all comes down to is the next, 3-6 months out, the next year, what is the big picture going to look like? And most importantly, for investors out there, how should we be preparing, or what's your strategy that you're going to deploy? Do macros matter here at all for
Yeah.
you?
So I would say yes, they matter. I will caveat it with I am absolutely not a macro expert. I am a, hobbyist macro understander or trying to, right?
Sure.
But I absolutely have been adjusting some specific things in my portfolio with those things in mind. And that's kind of, I had talked about earlier that I got out of my waste management position, not because of macro factors for that, but then I got out of Lowe's, right? Which has been, I mean, a prototypical dividend growth company that I've talked about on my channel. But I got out of them because I already had a bunch of retail exposure, right? I had McDonald's, I have Walmart, and I'm missing one. Oh, well, and I had Lowe's. And so when I compared all three of those companies, right, they all had their strengths and weaknesses and all that. But when I looked at it, to me, I feel like if we have an economic slowdown, McDonald's and Walmart, I think will do better than Lowe's. And that's just my perspective. I don't know if it's right or wrong, right? And actually, I recently added Starbucks in a very small position. But the idea there is that even in an economic slowdown, like when people look at Starbucks, it's looked at as like an affordable luxury, right? And this is the terminology that they've used in their earnings calls as well. It's like, okay, I'm not getting paid as much, or the economy's slowed down, so I can't go on that vacation, or I can't buy that car, but I can have my $5 coffee every day, and it gives me a little bit of joy, and I'm going to do that, right?
Sure.
Or like, McDonald's, right, where everyone's always going to want cheaper options for food, right? And it's a place where your kids want to go, so you're probably not going to cut that out compared to other things. And then I think Walmart's probably the best example of this, to where you have a company that's maybe Lowe's, right, which is a great company, and you still have the whole the professional end of the home builders and all that, and all that'll be there. But maybe your average Joe in the neighborhood isn't going to drive to Lowe's to get his hammer. He'll just go to Walmart instead, right? Because it's a little tight right now. And so even though Walmart isn't this high growth company, they're a very resilient company in terms of if the economy slows down, to where I don't think they'll get hit as hard as maybe a discretionary retailer. Like just look what's happening with Dick's Sporting Goods and all these kind of other retailers. They're getting hammered right now.
Sure.
Whereas, revenue growth is down, whereas Walmart is up over 5%, right? Which is still small, but it's up, even though we have some things slowing down. So I've done some things in my own portfolio to kind of shift to that mentality of my retail exposure is in the highest quality companies that, at least in my opinion, I could have, which is McDonald's, Walmart, and now a little bit of Starbucks. And then I've moved to these other companies that are more infrastructure, ecosystem, higher margin, Visa, Apple, right? It doesn't matter where you are in the world. If you're buying something, you're probably making money for Visa, right? So so I have made some changes because of that, but again, it's only a part of the factor. Like, I'm not totally upending my portfolio because of what I think is going to happen in the next 18 months. But I am trying to think through, okay, if something does happen, who's going to be the most impacted? And how can I make sure that I get into a group of companies that I feel really good about no matter what happens? So that's kind of what I've been trying to do.
Incredible answer, truly. I just, there's so many, again, questions that I have for you. You really are living exactly as I feel like I try my best to do as the CEO of you, right? The CEO of your portfolio, and getting to know the ins and outs of these companies, thinking ahead, as we shared before, and just talking about a CEO would know what the heck is going on with his business. They would look into the coming months. They would try their best to prepare for it, and hunker down. Now, remind me, Matt, how much money did you lose when it came to the Bitcoin deal?
So
or not necessarily lose, but how much was the AC unit?
Yeah, so here's the sad part about it. The Bitcoin that I liquidated didn't even pay for the whole AC unit. It paid for a portion of the AC unit because of the price that Bitcoin was at the time. And I think I ended up I mean, it was over 13 Bitcoin, and I think I ended up getting like maybe 2 grand, 1,800 for. I mean, just a
Sure.
ridiculously low number. And so it just depends on what price of Bitcoin you calculate it at. But I think at the all-time high of Bitcoin, it was over seven figures, mistake. So yeah, that's not fun to think about. But at the end of the day, it's um, I mean, I kind of laugh about it now, but it's like we always learn as we go. Obviously, you don't
Sure.
want to make a seven-figure mistake because those are ones that just hurt you. But
Sure.
at the time that I bought Bitcoin, I don't know how other people feel about it. I would have never guessed that it would get up to, mid 60,000s ever, right? Like it just wasn't even in the realm of possibility to me. Other people might claim that they knew all along. That's cool. But so, at the end of the day, that's what happens when you don't have a strategy. You don't have a plan. And that's kind of what hit me. And it's just a fun story now. And we can kind of laugh about it and hopefully things will be okay long term.
No, I first of all, I want to double down on that. You can never play Monday morning quarterback. The reality is, whenever you look back in your past, whether investing or in life, you're playing Monday morning quarterback. You would just,
Right.
as you shared best, you never know. You may say you know, but you'll never know.
Right.
I think the most wismatic thing I've ever heard, right, is my greatest truth is that I just don't know. And
Exactly.
I rock and roll with that every day of my life. I don't know what's going to happen to me today, for the remainder of the day, tomorrow, but I'm going to live in each moment. And the only real reason I ask this question is because I want to extend to you, because the seven figures there, right? I usually end these masters of the market by giving some virtual dollars over to my my interviewees, and usually it's 10,000. But for today, I want to be pretty generous, and I want to extend to you 1 million virtual dollars. And here's
Nice.
the name of the game that we play to end the Masters of the Market chat here is
Okay.
you got to pick one stock, just one stock to invest that $1 million into it. And you got to do it at the valuation, at the price point right now where it is today. What stock would it be and the why?
Um, what's the time horizon? That's my question for you.
Yeah. You say let's go with a decade out.
Okay.
So we can't play Monday morning quarterback in a couple of weeks day trading.
um, Man, this is so if I had your virtual $1 million, this is going to be the most boring answer ever. I actually probably would put it in something like SCHD. I mean, and it sounds so
No
so.
ETFs, no indexes, just
Oh, okay. No ETFs. No ETFs. All right. All right.
you're gonna make it interesting here.
Okay. Um.
I'll tell you, I had someone on the channel and he answered similarly, where he was like, he had a portfolio of 25 stocks. That's what he stuck with. And
Yeah.
then I asked the ending question, right? The $10,000 virtual question. And he really didn't answer. He just said, I can't because I picked the 25 stocks that I own. That's just how I invest. And the only reason I'm coming back at you with this one is because a viewer came back at me and said, well, that's not fair. He didn't answer the
Can't
question.
do it. Okay. You know, man, I would just I would have to say Visa. Like it's again, even though the valuation, I know people are going to be like, "Wow, it's at all-time highs." How could you say that? But it's just when I look at the margins of that company, and I look at how their revenue is basically inflation proof, right? So and I don't know how much you want me to dig into this, but they get paid in multiple ways. They get paid by number of transactions on the network, and they get paid by payment amount. So as inflation happens and payment amounts go up, they get paid more, right? So it's this kind of I don't know if beautiful is the right word, but it's this kind of beautiful inflation proof, revenue. And when I see a company that's like that, they're basically a duopoly with MasterCard. Their margins are just ridiculous. To me, their biggest risk is the government's doing something ridiculous to kind of impact their revenue. So
Sure.
to me, it's an easy answer. It's probably partially a cop out, but if you ask me today, what business model would you want for a business that was your own, it would be that one. So
It's a
yeah.
beautiful answer. Like we keep saying, and I hope a lot of investors out there who are watching this keep picking up on this crucial point. Boring is lucrative, and sometimes
Yeah.
exciting is meant for Vegas. So, I'll share that as we wrap up here. And investors, you have to head over to Matt's channel. I'm telling you one thing, you got to watch his dividend yield video, but you also got to check out his dividend stock idea videos, because I'm getting a lot of ideas from Matt. Everything that he's sharing over there, a lot of insights that he is dishing out. And I highly recommend heading over there immediately right after this video here is finished. With that, Matt, I want to extend a thank you to you. I've had a phenomenal time on this go round of Masters of the Market. You never know where these conversations are going to head, but when it's good, it's good. And it extends far beyond usually that 1 hour that I typically give it. So thank you for really, dishing out insights here, making me think. And I think just in the hour plus that we've had here, I've become a better investor. So I want to thank you for joining me. Thank you for all the insights. And now, investors, until next time, we will see you there.